Good morning, everybody. It is Tuesday morning, May 5th, 2020, and we are following up on the presentation from Friday where I talked about possible ramifications of reopening the economy too early and the actual underlying economic damage that we've already seen. Woke up this morning to see that the federal Treasury, the U.S. Treasury, is going to put another $3 trillion into the economy. And I would suspect that that's not the end of it. At some point, I believe that the federal government is going to have to ask for another shutdown and that it won't be left to the states next time. And that will require a few trillion more dollars to make sure people can pay their bills and small businesses don't disappear into the night. I hope that I'm wrong about the severity of what's going on. I hope that there is a V-shaped recovery. At this point, though, barring a medical miracle, I don't see that happening. And it is clear to me that a solid third of the population does not comprehend the seriousness of this pandemic, and that it will likely lead to a lot more death, given what some states are doing, jumping the hurdles for reopening too quickly, and the reality that there isn't a unified front from the top down in the country yet. I hope that changes because I think that if the president would make it a priority to shut down the economy and promise to take care of people, that we'd be able to push the infection rates and death rates down low enough that it would buy us enough time for those medical miracles to happen, which, again, I believe will happen. I just think are a matter of the calendar, not the hour hand on the clock. So, wrote a article, reopening too soon could cause a mega crash and depression. And I would just steer you, once you read it, to look at the comments and really ponder how many talking points get repeated over and over again from the herd of what I would consider the real sheep that are trying to tell us that this is still just the flu. I don't believe that. I think the numbers support me overwhelmingly. I don't even know that it should be a debate at this point. However, it is because people like to argue. So here's the report that we started walking through on Friday. I'm not going to walk through it again, but for those of you who haven't seen it, I do encourage you to read this report when I put it out later today, and to watch Friday's video if you haven't already. Today we are going to focus on asset allocation, starting with the ETF chart book, and then we'll move into the stock section, which I still have 4 or 5 charts to put up, but I think it'll be a good foundation for you to build around. I want to explain how to use the yellow, red, and green lines for scaling into positions and how you should consider those in relation to your risk tolerance. So I actually believe that I have an error here. I don't think we're at 7 ETFs right now. I believe there's a few more. I added some alternatives. But let's take a look at some of the core charts that you should be building your asset allocation around. And remember, the context here is that we are in the smart everything world now. It's coming even faster. The cloud, IoT, artificial intelligence, that's what the executives at CES this year talked about being the perfect marriage, and how it's going to drive a lot of things, including virtual reality, augmented reality, the whole machine learning platforms, manufacturing, supply chains moving, because a robot in America is not any more expensive than a robot in China. So why wouldn't you have your end production closer to your consumers and or your resources? QQQ is the large cap index that essentially tracks the newer economy. It doesn't have as many component pieces as the S&P 500 that are struggling. I would say that fewer than 10 companies on this index are unattractive in general, whereas well over 100 companies in the S&P 500 are unattractive. So at least two times more as a percentage basis unattractive companies in the S&P 500. And as we know, this index has far outpaced the S&P 500 over 1, 3, 5, 10, 20 years. And even including the dot-com crash, this has outperformed the S&P 500 by leaps and bounds in total return, which includes dividends. So you want to buy this at certain areas. And the word of the day is going to be confluence. What that means is that we can find support levels using Fibonacci ratios or all sorts of different economic indicators. But ultimately, many things pile up in certain spots. And that is a confluence of multiple indicators or multiple price levels converging from different time frames based on different factors. And that's really all these lines are. These are places where confluences say around this area is where you should look to start to scale in or add a lot more or back up the truck. Pretty simple. It doesn't mean that you buy automatically at the L line. You still have to measure the technical factors at the time. As we can see right here, money flow index, which is a volume weighted RSI, is turning over. And so you'll want to buy down in here somewhere. I don't know what price that corresponds to. Nobody does. But as this gets into the oversold area, and right around this line, it doesn't always go below the line, but as it gets close to the line, you want to say, okay, well, the price is here, or price is here. And you should probably scale in. Now, I've used all weekly charts because these will show stronger support levels. So as you get close to the oversold area, you probably can start to buy. If this were a daily chart, this would correspond to, this would be a higher shorter term range. Maybe the price is only here if you're, trading short term. As position traders, folks who want to hold our investments at least 6 months, preferably over a year and a few years, we want to be very careful about where we buy. The swing traders have a different approach. We'd be using 4-hour and 1-day charts over there. So it looks like a very basic Elliott wave I didn't put Fibonacci levels in here or anything, would suggest that Invesco's QQQ trust would get down to a lower low at some point this year. I would say somewhere in the 150s. I had originally thought it would go below 150 with all the money getting printed and the day getting closer to a medical miracle. I'm not positive about that. So I would say you probably start to scale in the 150s. And if we do get the Armageddon scenario, then you want to buy in this range between 150 and 120. But I think the 150s for sure you should be scaling in. And if you wanted to at least have a placeholder position in your portfolio, go ahead and buy in the 180s. There's nothing wrong with that. Got down to 170-ish before, and 180-ish, 185-ish, 188-ish would mean that this correction, this bear market is coming to an end, and that we're going to start to see a rebuild. And I would expect a choppy period before it really took off. I don't expect anything to take off to the upside until after the election and we get some certainty. But between now and then, we have to look at these different price levels, where to buy. If you want to be aggressive, I think you can buy in the 180s. I'm inclined to wait to the 150s. Doesn't mean that you have to. But in either case, keep an eye on this. You really want this to be in this range down here on the weekly chart. That'll give you a stronger long-term buy. ARC Innovation, I think, is a good complement to QQQ. It is a managed fund, about 40 holdings, but these are also new economy stocks, and a lot of them are mid caps that could be added to the S&P 500 at some point. Again, 40-ish, you can probably start to buy in, but I'd be really looking for middle 30s to lower 30s is where I'd feel most comfortable. And then your Armageddon scenario is way down here. The Van Eck Gold Miners ETF, and I didn't put the gold trust on here. I will, I guess. I'm not excited about gold, particularly because I think the gold miners do much better. But we have discussed that having some gold, proper physical ETF, could be a way of blending your risk profiles to maybe give up a little upside, but to just give yourself more diversification in the space. I like the miners because they're not just gold, they're also silver and other rare metals and industrial metals. I think that these sell-offs down here are unlikely to happen again. I think this had to do with the margin sell-offs, which I don't think will be as great next time because there has been deleveraging. But I think in the middle to upper 20s, you really have to add to GDX, especially if you don't have it yet. The argument for a long-term bull market in gold stocks is pretty overwhelming. Invesco Solar ETF, I believe that the 2020s will be the solar decade. Everything is leaning in that direction, every growth rate, every contract, every government. And we know that the fossil fuel era is ending. It's going to end slow, but it's ending. But again, somehow got overbought again on the weekly chart, and we needed to come down here to being close to oversold. You can see that this bottom might be what you should be eyeballing rather than actually becoming completely oversold. This is just take a look at this. That was a great rally. And this correction, which is pandemic driven, because I don't think it ever would have gotten, much below 30-ish if it hadn't been for the pandemic. Now should give you an opportunity to buy down here. A lot of us bought in the low 20s already. So if you haven't sold long-term calls, maybe you sell long-term calls up here while we're up here. And then when the price comes down, sell some cash secured puts against all that nice cash that you're sitting on. If you don't have tan at this point, again, then you're just looking to add it as it gets down towards the yellow line. iShares Semiconductor ETF, the brains of the smart everything world, cyclical, but less cyclical than in the past, and riding a massive secular trend. So will we see it break below this yellow line? I'm not so sure. I might even be inclined to start adding to this position up here if I were aggressive. I'm not going to be aggressive, so I'll wait for close to this yellow line. Remember, QQQ and ARC both have semiconductors. So when you're trading a specific industry, you really want to get to the edges, right? You don't want to trade the middle of the market. I think that you're safer down around this yellow line, but you can see when it crashed, it didn't come all the way down. So, maybe this yellow line should be higher. So that would be the one thing I would tell you is maybe all these lines should be higher, or at least the yellow and the red lines. I'm not willing to make that commitment just yet, but that might be the direction they head. I don't think they head lower, but the red line could get bounced up to where the yellow line is, and then the yellow line could get put up here near 180. I'm just not ready to do it yet. iShares expanded tech software. Again, if you wanted another way to get into large cap technology, maybe have a little less QQQ and a little bit more of this, you could. Again, it's got semiconductors in there, a lot of the same holdings as some of these other portfolios, such as QQQ. I like to simplify things a little bit more than that, or try to get something that's a lot more specific. So this has around 100 stocks in it. I think if you're going to go more sectored, industry-focused funds, right? If you're not going to have that core QQQ fund, you can use this, then make sure you add other industries as well. I'm unlikely to use this. That's just not the approach that I like to use. I'd rather have QQQ as a core and then have 3, 4, 5 ETFs that I trade around it that are much more focused. Easier to trade, a more focused index. But again, if you want broad technology, this is the one. Next gen internet ETF. I've included 3 ARK funds here just because they're so well managed, and we cherry pick some of their stocks. If you don't want company specific risk, then this is a great way. These ARK funds are just a great way to get the upside of focused portfolios in growth spaces without having to do it yourself and without having to build a 30, 40 stock, 50 stock portfolio. As I've said, I don't think it's really possible for anybody to manage more than about 30 stocks effectively, unless you have staff, right? Unless you have a lot of people working for you. So I would err towards some of these more specific sector ETFs and only stick with their very favorite stocks. I think it's clear that biotech is going to be important forever. And much like the gold miner stock index, this has had a long period of consolidation and is getting to the point where it could break out. I would suspect that sometime in the next year or two, this breaks out to much higher highs. So I think you want to buy it on pullbacks. These companies are cash rich. They're very profitable. And companies like Amgen are kicking out dividends already. We're 20 years into the whole biotech revolution post, coding the, starting to code the DNA markers. So I think that you can just take a look at this chart and say, wow, that's really consolidating in the right direction. It's not going to fall off a cliff. Doesn't mean it can't have corrections, but if it does, I think you want to buy it. And I think this will be one of the ETFs that we trade because we know the trend is on our side, but it's going to give us enough volatility to make some trades. So over at Fundamental Trends in the Swing Trader service, get used to IBB. Genomic Revolution, smaller companies that's on IBB, again, managed, but look at this track record. They've done a very good job of identifying a 30-40 stock universe and trading it well. Again, they have a team to do it. It's worth paying these folks, their 75 basis points, I think is what they ask for, to get this exposure if you don't want to build your own basket of smaller and mid-size biotech stocks. I mean, we have just we got 400 subscribers now, and we really have some super qualified people on the biotech side. And one of the only industry-specific newsletters I subscribe to is a biotech one. So we're going to trade some of these biotech names over on the swing trading service at Fundamental Trends. However, I don't know if you're at margin of safety if you should have the individual names in biotech. I think you should probably stick with the funds. unless you want to add like an Amgen because of the dividend or something like that. The Invesco low volatility ETF. Of the low volatility ETFs, this has one of the highest dividends and lowest betas. iShares is close. You could probably substitute that. But between Invesco and iShares, I think that these are the ones that you would add if you want some exposure to the S&P 500 beyond what QQQ gives you, and something that will offset some of the volatility in some of these other places and drip some income into your portfolio. So if you want a dividend yield that's above the S&P 500, and you want some of the higher quality names in the S&P 500 that aren't in NASDAQ, this is the place to go. I actually think that there's a pretty strong argument if you just wanted to be a large cap investor that you might go about 3-to-1 QQQ to this one. And if you just wanted to be a bogglehead, right? An index, I think between QQQ and this ETF, you could set it and forget it if you were cool, beating the indexes by a couple of points with a little bit less risk. That really isn't a horrible approach. Oops, I didn't retitle this one. Oh yeah, I did. Equal weight. There you go. I like this utility ETF, and I'm not in it right now. There was a huge rally, right? A little bit of a consolidation, and then another huge rally the last couple of years. Most of this rally has to be wiped out. Even going back to the start of the Trump era, and it did for a hot minute, and then it jumped right back up here. So if we were going to buy utilities and get a replay, I think we may have missed our chance. But if we can get this index back down in that 75, 70 range, I think you want to do it. The reason I use the equal weight is because it's just a risk management tool. Dividend is good, but utilities should be traded cyclically. I think there's pretty strong evidence that if you drew a box from here to about there, so from about 70 to 90, you can see that it was in that box for a long time before it broke out. I wouldn't want to buy it outside of that box. Could you make an argument for buying it, on a $2 or $3 pullback? I guess you could, but I really want to be at some of these points that it kept playing with on both sides. I'd really like to get it under 70. I think that $69, $70 price range is just about perfect. So those are the ETFs. Somebody asked about the difference between IBB and Genomic Revolution. It's the size of the companies. These are all large cap companies. This is a blend of small, mid, and large cap. This is an index. This is this is managed. They work pretty well together. They're pretty complementary. So if you wanted to have 12% in biotech, knock a couple points off for what you have in QQQ, and say, okay, well, maybe I want to have 8% of my money in IBB and 2% in Genomic Revolution, or 4%. If you really just wanted to overweight that much. So, think of it that way. Imagine all these funds as stocks, and if you're managing them, it's still 10 funds. So it's still a lot to do. And always manage your asset allocation. I use, those 2, 4, 6, 8, 12 percentage markers as ways of looking at my portfolio, and in my head it turns into a fraction which goes into the pie chart. So if you can try to do that, I think you should. Again, look at how many of these are overbought, though. They're all overbought on the weekly. There's going to be a correction. We just don't know how big and how soon. Yeah, no way I'd want to own a defense ETF. There are some companies I want to own, though. So 100 growth stocks, looking for fireworks, and several that could be added to the S&P 500 soon. Google is just one of the best companies in the world, right? Into everything. They're getting into the cloud now, which is what they had some success with in their recent earnings. Service potential is massive. The advertising growth will resume at some point, and then baby Google's. So probably should have bought some at $10.50, which is a price I talked about a million times. We didn't. Then again, you can buy in the 900s. So I'm inclined to buy down around this yellow line. I just don't know, short of some of those horrible scenarios we've talked about, that it gets much below that. I mean, these guys have so much cash, that it's kind of obnoxious. Alibaba, this is my one Chinese company, and it's because they are the cloud leader. They're basically 5 years, 6 years, 7 years behind Amazon in a bigger market, and they dominate it just as much. We've missed Alibaba twice, by the way. I don't want to miss it a third time. I mean, just look at that trend. Higher lows all the way across, higher highs all the way across. You know, if we get lucky as investors, bad for humanity, lucky for us as investors, the horrible realities of that whole equation. If we can buy it between the yellow and red line, I think that's awfully good. Could it get below the red line? Yeah, but again, something horrible is happening. I would just soon have the world be better and buy it up here. But again, we don't know. We have to keep our eye on the ball. Enphase operates in a duopoly in the solar inverter space, and it's a major leader in power management on smaller projects, commercial and residential. They're the play. So you could own SolarEdge as well, which gives you some international exposure and access, access to the larger projects, which is where they have a lot of the lead, and they're going to get utility contracts. So it doesn't hurt you to own both Enphase and SolarEdge. Instead of owning like 4% of your portfolio in Enphase, maybe you go 2% SolarEdge, 2% Enphase, and then you have your percentage in TAN as well. And then Sunrun and SunPower, which aren't on this list because they're too small for today, are other companies that you could add to the mix. Square, major play in the digital transaction future. I think we may have missed our opportunity to get this super cheap. I think we missed this one. I think I should have played the trumpet there. I'm sorry. But I do think that we get it under 50 at some point, and we should probably take that opportunity. They're a takeover candidate. They have crypto space exposure. Small business rebound will happen when it happens. Solid financials, could be added to the S&P 500 very soon. Roku. Somebody published an article, it might have been in Barron's, that was talking about how with all of these streaming services that are out there, they think the bundle is coming back, and I've talked about that. The best place to do a bundle of streaming service is going to be through Roku, where Roku can cut a deal with Disney and Amazon and say, hey, why don't we make Disney part of an enhanced Amazon Prime or something. I think they're going to be able to combine services through bundles where maybe Roku takes a part of their commission and says, okay, here's your discount. We're going to split our commission with you. Something along that line. I'm sure these streamers would have to raise their rates to give you a discount from the raised rates. But I think a lot of that is coming. So we'll see how that goes. But Roku just makes it so easy to have streaming. I don't know why anybody would buy a television that doesn't have the Roku built right in. Why would you want the extra box? I know you got Google and Sling and all these other things that are out there, but having used them all, the ease of use of Roku is just so far beyond anybody else that I think it's going to become the de facto standard. And I would see this company growing more and more, and they have ways to monetize their platform more and more as well, especially as people have to pick and choose between streaming services. I think that that's a big deal. So Roku, which is a momentum favorite, you got to be careful of being the sucker. And the chart doesn't look great here. So I do think we get a pullback on this, under 100 for sure. How far under 100, hard to tell. But between the yellow and the green line, I think we got to be buyers. PTC, I think the thing that people miss about this company is that as supply chains move back to America, they are going to just do better and better and better. So again, chart doesn't look great. And we talked about this in the bigger context above on Friday. The economy really did start to turn over, and by the end of 2018 into 2019. This chart is reflective of that. So if we get a chance to buy between the yellow and green line 2 or 3 times, and then next year, as the pandemic plays itself out, vaccines come online, and whatever gigantic massive stimulus they do next year occurs, stocks like this go back into their growth phase, and they head back up to their highs over a period of years. It's just a matter of, lowest cost basis wins the most. So if we know that it's going to go back over 100 someday, the closer we get it to 50, the better for us, right? I think that's what we should be targeting. Workday, software as a service. These guys designed their companies to be taken over or bought. This company could be, in that boat. But it's also, they've changed the public float to qualify to be in the S&P 500, which I think happens probably this year. I'd be shocked if it's not this year. But if not this year, then next year. So if we can buy again between the yellow and green line, that's where we want to get to. And probably the yellow line, I start selling cash secured puts, and I just start buying it at the red line. And again, I have to reconsider whether I take margin if we get all the way down to these green lines. I mean, if the world gets us down to these green lines and we actually see that 60% drop in the S&P 500 from here, right? You just hold your nose and you buy everything you can. Zendesk, another great company, part of this whole work from home thing that's going to accelerate and remain entrenched. I don't see working from home going away. After people do it for the next year or two, how could companies say, hey, come back into the office 5 days a week? If there's no change in productivity, why wouldn't they let people stay home? Again, the whole downstream from that, from energy to office space, is just so full of loss that the gain has to go somewhere else, and it's going to be companies like this. So again, if we can buy this between the yellow line and the green line, more likely between the yellow line and the red line, we should do that. Shopify, I've been doing a little bit more digging on this company, and I like it more and more. I think that people, what they don't understand is that they are becoming a legitimate competitor to Amazon. They bought a logistics and storage, warehouse company. They're going to do for small businesses what Amazon is doing for a lot of people already. But a lot of small businesses don't like working with Amazon for various reasons, including that they get their ideas stolen. Shopify can offer an alternative, and as a Canadian company, they won't get into the S&P 500. But I would argue, from an ethical standpoint, maybe they have a little bit more, just a higher bar. And I think that the small businesses will like that. So if the small businesses don't feel threatened by getting their ideas or their products redirected from Amazon, I think that they will like what Shopify does for them. And I would relate it to back when I was, slinging financial products. There were certain companies I didn't want to work with because I knew they'd go behind my back to try to steal my client. It's the same thing Amazon does. So I think Shopify's got a bright future. I think that it's overpriced, but if we can get it in the 400s, I think we probably have to buy it. If it gets anywhere close to 300 ever again, I think we gotta load up the truck. Again, for the price to fall down into this range, it's going to take an awful lot of pain in the economy. For sure, I think we can trade this over at the the rare swing trading service at Fundamental Trends, but I think you have to buy this down in here. I think it would be like going back in time and knowing what the answer was. Teladoc has screamed higher, broke out, and I think you need to see it come back. We need to do a deeper dive on what we should expect earnings to actually be over time. But there's no doubt that the future of follow-up medicine, maybe not at the diagnosis phase, but follow-up medicine is going to be virtual, largely virtual. So Teladoc has a bright future. Now, Facebook and Google and Epic, and there's going to be competitors. There's no doubt about that. But this company has a strong tie-in to the group health plans. It is on the right side of history. I don't know that I would buy it at the yellow line. I'll let ARK trade it for me instead. But way down here at this red line, if it got around 100 again, I'd probably add. All right, 10 dividend stocks. Core holdings that can beat the S&P 500 to the dividend stream. Now, if you can beat the S&P 500 safer and with income, why wouldn't you do it? I know that people like looking for higher yields, but I think that that's dangerous in many ways. I think you need to look for the solid balance sheet and the growing dividend more than the big dividend. The big dividend often represents a mature company with no growth. It's going to struggle to keep the dividend, or a company that's already highly leveraged. So, number one, dividend stock. I'll give you a present. I'll put it right on your teacher's desk if you can guess what company it is. Come on. Why would I? Good, there you go, Apple. How big of a hint could I give you? Put a gift on your teacher's desk. Yeah, Apple. If you can't find an excuse to buy Apple, then you should be buying your own stocks. I mean, seriously. We've missed this a couple times. I bought it way back at 57, and I sold it at like 120 something. And where I sold it ended up being the new support line, which is, I think, pretty funny. I bought it way back in here, 57 split. I almost got it at the bottom. I wrote the article in MarketWatch when I did it. So I wrote it all the way up to here and then up to here. I got rid of all my Apple here. So again, I'm stupid. And now I'm looking for a way to get back in. I think that this 230 area, which touched that, Buffett didn't buy there. And I understand why not. It's got a slowing growth rate, but it's just going to kick out more. It's just going to kick out cash and cash and cash. And it's such an asset-light business. So even though they have hardware, and they're going to, for the people who love their iPhone and you want a homogeneous experience with entertainment and your IoT in the home, Apple's going to get into all of that for 20 to 30% of the population. So they might not be the biggest, although I think in a lot of the products other than cell phone, they're going to be. They can use their market penetration in cell phones to get into all other types of IoT stuff and entertainment. I do think that they're a favorite to buy Warner from AT&T. Would I buy it again at 230? Well, if the chart was oversold, yes, I would. I'd sure love to get it down in the 170s. That made me feel better about myself. But I think around 230, you just gotta check this chart. Is it heading down? Then you just keep waiting until it gets down in here. Lockheed Martin, another one of the great companies. Somebody asked about defense contractors earlier. We have 2 defense contractors. I haven't done the other chart yet, but Lockheed Martin and Northrop Grumman are 2 of the companies that you want. And I think that you should be looking to get this company. You know, I don't know that it gets below the 250s, 260s, 270s. And I think you can even look at it right around 340. But I think we get another bite at this one down in here somewhere. 280-ish, that'd be my guess. Love to get it 250s. Don't know that'll happen. We'll see what happens to the economy. Home Depot, again, this is actually a pretty strong support line, this yellow area. I mean, you can really make this into a box, right? Which is what you should imagine with all these lines. It's just imagine where the box goes. Home Depot, you know, essentially a duopoly with Lowe's, and then every region has their Ace Hardwares, their True Values. You know, in Wisconsin, we got Menards. You know, there's a couple other competitors wherever you are. But Home Depot has such good relationships with contractors, and they're in all the right spots, that as millennials either buy houses or build houses, they're going to be in Home Depot all the time. So I think that Home Depot is one of those companies that they don't have to build many more Home Depots, right? They're already everywhere. So they don't have gigantic capital expenses anymore, and the real estate's just becoming more and more paid for, you know, the real estate that they own. And I'd have to double check. I think they have that spun off into a REIT, but I'd double check that. So, you know, I think Home Depot is a stock that we get more and more familiar with because in the 2020s, there has to be a housing boom, either through redevelopment or new construction. And I actually think new construction is going to do very well around the smaller towns that are around the big cities. You know, so a lot of those towns that lost population, I think they're going to get it back. Why? Because the whole work from home, move to a better school district sort of thing is just going to accelerate. So urban sprawl is going to come back. Home Depot will be a beneficiary of that. Microsoft, another dividend player, getting to be very big in the cloud. You know, they're going to be one of the 4 or 5 companies that dominate cloud, and there's a lot of recurring revenue there. Now, I do think it got carried away this whole run here anyway, and it came back. And the question is does it come back to this level? I don't know that I buy much Microsoft at 140 because I'm going to have it in QQQ anyway. But 120-ish, 115-ish. Yeah, I'm buying Microsoft. Have a couple more to put in there. I really am undecided about a couple, but all of the must-own stocks will be in there. Lam Research, you know, semiconductors again. If you want to own semiconductors and you want something that pays a dividend, here's your stock. So you own an ETF, you know, you own SOX. And then Lam Research, you know, and again, not a huge position, 2% of your portfolio maybe, 1, 2, maybe 4% if you fall in love. But this is just another good company for your dividend basket to be a great anchor. And again, not a giant dividend, a little south of 2%, but it's going up. And this is an industry that's just going to keep churning out money because the smart everything world isn't built yet. And it's in the second inning. So there's a long runway for these guys. And I would say another company that's similar to these guys is Taiwan Semiconductor. So I think Taiwan Semiconductor is somebody that we look at for some international exposure, and it gets us on to the picks and shovels side of semiconductors. All right, I have a couple more slides to rebuild, but that is pretty much that. What questions do you have about VSL companies? Not many today. Yeah, General Dynamics is okay. The reason I like Lockheed Martin more than anything is because their other technologies are truly transformative, right? I mean, they're going to be a big player in water desalination at some point, which it has to happen. And somebody pointed this out on the telephone with me last night, which I've said, but it's important to know, is with water desalination, right, as the sea level rises, it's kind of a double good thing if we start getting our water out of the ocean, right? We have to figure out what to do with all that salt, but there's ways to use it. So I think that we should keep an eye on that. Micron is a growth stock. I like it. I like NVIDIA too. NVIDIA is actually going to be in the dividend list, which I'm stretching to put it there. But NVIDIA and Micron, they're clearly companies that go into your growth stock basket. It depends on how much you're doing with ETFs, right? I mean, there's legitimately a couple hundred good companies out there, really good companies, and you could trade them all if you had a great system and you did it full time. But at some point, we have to simplify our portfolios, and you only want the stocks that are home run stocks. So if you're, on the growth side, you're looking for home runs, right? On the dividend side, you're looking for beat the market by 2 to 4 points and less risk. So that is really the parameters. You can do a lot of things with ETFs. And again, I really encourage you to have about half of your portfolio in ETFs and about half in stocks. I think that just ends up being a great blend. If you own 20 to 30 stocks, I think that's manageable. And I think it helps you overweight where you need to be. And it helps alleviate any company-specific risks, to blowing you up. If your average position size is 2 to 4% versus, 6, 7, 8, 10%. So I think we're going to call it a day on that for the recording, and then I'll stay on for a couple of minutes. So for those of you listening, when I open this to the public in a couple of weeks, you'd love to be a member because then you get it in real time.